Today, I want to tell you why we're almost guaranteed another market crash and also why you shouldn't be worried about it. So, in just a minute, I'm going to break down why you should be prepared for another market crash, why you shouldn't be worried about investing at all-time highs, and also why most investors lose money. But first, my name is Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping 1 million people retire without worry. Now, before I dive in, I should say that this is not investment advice. I'm just a guy on the internet who likes to run his mouth. Now, I said something like that once and somebody replied, but I thought you were a financial advisor. To which I replied, I am a financial advisor. I'm just not your financial advisor. Now, I don't typically talk about markets much and investing a lot, but over the next few weeks, I want to talk about investing and about markets because I think there are some blind spots that hurt a lot of investors and hurt a lot of retirees. So over the next couple of weeks, I'm going to tell you something I see that I think is concerning in the market. And I'm also going to tell you the tale or the story of 2 market crashes that just might save your retirement plan. So if you don't subscribe to the channel, go ahead and subscribe and ding that bell so you will be notified when every new episode is released. But today I want to talk about why I think you could see another painful market crash and why you shouldn't be concerned about investing at all-time highs. Since 1928, the US markets have had an annualized return of nearly 10.5%, meaning if you put $1 in the market in 1928, you came back and checked it today, you would have $18,643 in your account. Not bad. But it gets even better. Since 2009, the markets have compounded at nearly 15% a year annualized, which almost none of the smartest minds on Wall Street could have predicted. But behind those numbers, there's been a lot of bumps in the road, and those bumps and emotions cause investors to lose money. So today I want to actually look at some of the numbers and give you some concrete data. And I got some of the data from a blogger by the name of Ben Carlson, and then some of the more recent data from JP Morgan. Now we know markets go up. In fact, over the past 100 years, the markets are up nearly 75% of the time. But what we don't think about is that markets are often down a significant amount on an intra-year basis. So even if the market is up for the year, it's very likely there was a large drawdown at some point during the year. And here's a really fascinating data point. Since 1928 through 2023, the average intra-year drawdown was 16.4%, meaning that at some point during the year, on average, the market was down by over 16%, even though during that same period, the market ended the year positive nearly 75% of the time. Now, I should mention, if you look at the data, not from 1928, but just from 1980, the inter-year drop now is only 14.2%. But let me make these numbers a little more concrete and a little closer to our lifetime, since most of you watching weren't investing in 1928. Since 1980, so 44 years ago, the market has been down 10% or more over 50% of the time. Meaning that out of the past 44 years, it was down by 10% or more intra-year in 23 of those years. So over the past 44 years, if you were investing and you were watching the market every day, at some point during 23 of those years, the market was down by 10% or more. And 10% is a significant drawdown, but it gets even worse. From 2000 to 2023, so the past 24 years, the market was down intra-year, so at some point during the year, by 10% or more, 58% of the time. So of the past 24 years, it was down intra-year 10% or more, 14 of those years. But it gets even worse. The market was down by 19% or more, 33% of the time, meaning 8 of the past 24 years, at some point, the market was down by nearly 20% or more. Now, one interesting caveat, when I was running the data, technically, a bear market is when the market is down 20% or more. Often the market would be down by 19.5, and then would reverse and go back up. So I went ahead and ran the numbers back to 19%, because honestly, if your portfolio is down by 19.5% or 20%, you feel basically the same way about it. So let's turn those abstract numbers into real numbers. Let's say you retired 25 years ago in 2000 with $1 million. That means that over the past 24 years or 25 years, this data just runs through 2023, you would have seen 8 different drawdowns where your portfolio would have been down by at least $200,000. If you have a $2 million portfolio, it's very possible that portfolio would be down by $400,000. And the thing is, if you retired 25 years ago, that portfolio might have continued to grow. And you start with $1 million, maybe it's $1.5 million. Well, 10% of $1.5 million is 150,000. 20% of $1.5 million is 300,000, right? So these are painful drawdowns. So here's why I say I can almost guarantee you that a market crash is coming. Now, I don't know when that crash is coming. It could be a year from now, or it could be 5 years from now. But if you have a 30+ year retirement, it is not improbable that you may see 8 to 10 painful market corrections where the market could be down 20% or more. And every one of those is going to seem scary and is going to elicit fear inside of us. Not because you're bad at investing, but just because you're human. And here's what happens, particularly once we enter retirement. We panic and we want to stop the bleeding. And so we sell at exactly the wrong time. Now, here's a really interesting anecdote. Peter Lynch is one of the most famous investors of all time. He managed Fidelity's Magellan Fund from 1977 to 1990. And under his management, the fund averaged an astounding annual return of 29% a year. But here's what's incredible. According to Fidelity, at least this is what I've read, the average Magellan Fund investor lost money during Lynch's tenure. So how does that happen? So if you look at the annualized return, Lynch had 29% a year, but there were a lot of years where he was up by a lot, and there were a lot of years where he was down, often more than the market. So Lynch had some exceptional years where one year I think he was up by, in 1980, I think he was up by 70%. The next year he underperformed. So investors who hopped onto the train in 1980, they were incredibly disappointed as they began to watch the amount of money that they put into that fund dip and dip and dip. And it's human nature that they jump ship looking for another market winner. And in doing so, they locked in their losses. Had they stayed with the fund for another 10 years, they would have had an average annualized return of more than 25%. Here's another interesting data point from an organization called Dalbar. I don't know if I'm pronouncing that right, but they do research on the impact of emotions in the market. And from 1990 to 2019, they found that the S&P returned nearly 10%, but the average investor during that same time period returned 5% annualized. Unless you think it was caused by diversification, right? Maybe they had too many international stocks or bonds, and that's what pulled their numbers down. I ran the numbers on an index of globally diversified stocks and bonds. So 60% globally diversified stocks, 40% bonds. During that same time period, it would have been up by 8.72% with significantly less volatility than the S&P 500. And once again, those are annualized numbers. So that's the average during that 10-year period. So the S&P was up by almost 10% during that period. The 60-40 portfolio had an annualized return of 8.72%. And the average investor had an annualized return of 5% during that time period. But this isn't only an equity issue or a stock issue. We see the similar thing in the bond market. Despite an average intra-year drop of about 3.5% in the bond market, bonds have been positive, according to JP Morgan, 43 of the past 48 years. So almost every year over the past 50 years, bonds have been positive. But during that period, there have been a lot of drawdowns, and the average has been about 3.5%, right? So bonds do go down. Now, ultimately, they tend to be up, but they move around up and down, just like stocks. Now, not as much as stocks, but they move. But we get ourselves into trouble because we chase returns and we try to time the market. Either we're trying to stop the bleeding or we're trying to get on the next rocket ship. So we either allow fear to cause us to sell at exactly the wrong time, or we allow greed to cause us to jump on the rocket ship, like buying Nvidia or buying Tesla at exactly the wrong time. We've watched it go up and up and up, and we can't stand hearing our friends tell us how much money they've made any longer. We jump on the rocket ship right before it begins to go back down. One of the other mistakes that I see investors make all the time is they'll say things like, this feels like the top, stocks have made way too many all-time highs. Maybe we should sell. Or I'm going to wait until things pull back and then I'll get back in the market. And I'm really grateful to a blog post by Ben Carlson for the data that I'm about ready to go over. Over the past 10 years, we've experienced 300 all-time highs. In fact, we experienced a new all-time high in 9 of the past 10 years, but it gets even more interesting. New all-time highs happen very regularly. Around 7% of all trading days since 1950 have made a new all-time high. On average, that means you have a new all-time high about every 14 trading days. Now, does that mean you should go all in on Nvidia or the S&P 500 as it makes new all-time highs? Not at all. You need a portfolio you can hold and a portfolio that allows you to spend the money when you need it without creating an income death spiral. But that's for another video. Okay, I'm going to leave it there for now. I will try to put up a blog post with some of the charts that I went over in the video so you can look at them a little closer on your computer screen. And if you're watching on your smart TV, I'm going to try something new and I'm going to put up a QR code that will take you to that post. So let me know if that's helpful or if you end up using that. And as I said, over the next couple of weeks, I'm going to talk about markets a bit more. I'm going to talk about something I see that's concerning in the market. And I'm also going to tell you the story of 2 different bear markets and how the information that I go over could end up saving your retirement plan. But if you want something to watch in the meantime, I have a video about how I approach markets and how it would have worked for someone who retired 25 years ago and needed to pull money out in retirement. And you can watch that video now.